So I'm going to just jump in and get started. My name is Michelle Fitzpatrick. I am with Northern 1031 Exchange. We're a wholly owned subsidiary of Northern Bank based in Woburn. So I am thankful that you're all here today to talk about 1031 Exchange, learn a little bit about what a 1031 exchange is and how you can help your clients. We'll have people that are realtors. We have attorneys. We have a financial advisor. So it's really, we'll have an investors on this session. So this is really going to be an overview, what you're going to look for your clients, and some strategies to help them. Just so you know, this is being recorded. So if you don't feel comfortable on the recording, you can shut your camera off. But just know that if you have your camera on or you have your microphone on, you're consenting to being recorded. The recording will be sent out after the session ends. Hi, Jim.
Hello, good morning.
Hi there. Nice to talk to you again.
Nice to see you.
Thank you. So let's jump into it. These are the things that we're going to talk about today. So we're going to talk about the IRS code, what it is. Very simple. We're going to talk about capital gains taxes, what your clients are actually going to be deferring using a 1031 exchange. We'll talk about the timeframes because the IRS is very specific in the timeframes and the rules that you have to abide by, along with the identification rules. Again, very specific rules. We'll touch on titling and taxpayer, and then we're going to talk a little bit about financial planning, about what a stepped up in basis means and what that means from an estate planning standpoint for your clients. We'll talk about the primary residence tax exemption along with some, I think I threw some rev procs in there, but I'm not probably going to go in too deep into them. So what is a 1031 exchange? This is it. This is the IRS code right here. It simply says that if you are selling an investment property or selling a property that's held for investment purposes or business use, and you use those proceeds to purchase a property that's going to be held for investment purposes or business use, you can defer your capital gains taxes. So a 1031 exchange, you are not eliminating your tax. It's not an exemption. It is simply a deferral of tax. So you're kicking the can down the road. If you're selling a property, if you're exchanging a property today and you purchase a new property, you're essentially carrying the tax basis over from the old property to the new property. So if you go to sell that new property, you're going to pay the tax that you would have paid on that first one. So it is simply a tax deferral. Very beneficial. What's great about it is that if you continue to defer, we have a saying in the business, it's called swap until you drop, exchange until you die. If you continue to exchange your properties, deferring your tax, if you pass away with the property in your name, that tax goes away and your heirs will inherit what's called the stepped up basis. So whatever the value of the property is on the day of your death, your heirs will inherit that basis. So really, really beneficial estate planning tool. These are the things that I'd like. If there's nothing else I leave you with today, this is what I want to leave you with today. Tips for a successful exchange. One, you have to buy a property that's equal or greater in value. So a lot of people will say, I bought a house for $500,000. It's now worth $750,000. All I want to do is reinvest the $250,000. That's not the way an exchange works. An exchange works if you purchase a property for equal or greater in value to what you've sold, less the closing expenses. So you don't have to reinvest the realtor fees or the attorney fees or any of the fees to close on the property, but you do need to buy something equal or greater in value. And that includes the mortgage too. So if you have, if you are selling for $750,000 and you have a $250,000 mortgage, you still have to buy a $750,000 house, even though you only have $500,000 to put down. So really important. The other thing is that you have to use all the cash proceeds. Anything that comes into the exchange account has to be used towards the purchase. So again, we'll use that same $750,000 example. If you have $750,000, $500 of equity comes into the exchange and you are buying another $750,000 property, You can't take out a $500,000 mortgage. So you have to use all of the exchange proceeds. Continuity of taxpayer in title. So sometimes the taxpayer in the title are different. Sometimes clients will have a trust that is the title holder, but they themselves, it's a disregarded entity, and them as a person or an individual pay the taxes. So we always default to whoever the taxpayer is if the title and the title and taxpayer don't coincide. But if a two-person LLC owns a property, that same two-person LLC needs to purchase the replacement property. Same if it's an S Corp. If it's a husband and wife, they're buying a property, they need to take title in their names. So same continuity of title and taxpayer. And then the last one, so important, please engage the qualified intermediary prior to the exchange. You cannot do a 1031 exchange once you've closed. So if somebody comes to you and says, oh, I'm selling an investment property, at least have that conversation about a 1031 exchange, and at least that they know about it, because once they've closed on the property, it's too late to do a 1031. Again, feel free, for the people that have just joined, you can feel free to turn on your cameras, turn on your mics if you want, and ask questions as we go. So wanted to talk a little bit about the taxes that would be if the capital gains taxes. So if you chose not to do a 1031 exchange, it's not just a 20% federal capital gains tax. There are multiple taxes that are involved. So the first one is the federal. I'm going to talk about the federal capital gains tax. It's either 15 or 20%, depends on your tax bracket. Most people that are in Massachusetts that are selling a property, because the values of the properties are so high in Mass and where we're located, most people would fall into that 20% tax bracket. The second one that I want to talk about is the federal NIIT tax, which is 3.8%. So that's a net investment income tax. It's formally called like a Medicare surcharge. So just on the federal side, we're looking at 23.8%. And then I'm going to get to the recapture depreciation, but Massachusetts state tax, we have a 5% Massachusetts state tax. And anybody that has, for every dollar over $1 million, that is income, is going to be taxed at 4%. So I have a ton of clients that are on Medicare, that are on Social Security, that have a two-family house in Somerville that is now going to sell for $2 million. They are going to fall into this Medicare, this millionaire's tax. So they're one big asset. They sell it once, they're all of a sudden considered a millionaire. So it's kind of a bummer. But that's just the reality of Massachusetts taxes. One of the biggest taxes is the recapture of depreciation. So if a client has owned a property for 20 years and they've been using this property and depreciating it every year, that's a benefit that you take on your taxes every year for owning an investment property. However, when you go to sell, the IRS is like, wait a minute, we want to recapture some of that benefit that we gave you over the last 20 years. So they take back 25% of the depreciation that you've taken throughout those years. So that's a pretty big nut. If people are selling properties that they've held on to that are fully depreciated, which is often the case, the recapture depreciation is a fairly big tax to incur. I like giving you just I'm going to do this really quick, but I like giving you a breakdown of what this would look like. If somebody bought a property for $500,000, they put $50,000 worth of improvements in, and they have to be capital improvements. So, roofs and kitchens and bathrooms, things like that. But they took $150,000 depreciation over the last 10 years. That brings their tax basis from $500,000 to $400,000. So now every dollar over $400,000 that they sell this property for, they're going to essentially get taxed on. So in this case scenario, they've sold the property for $1.2 million. You take out the basis, you take out the $80,000 of cost of sale, the realtor fees, the attorney fees, transfer taxes, things like that. And now they're left with a $720,000 gain. So if you take the 25% of the $150,000 depreciation, you're going to get 37,000. You're going to take the capital gain. We did the 720 times 20%. We did the 3.8% of the 720 and the Massachusetts tax. We didn't even add the 4%, we didn't add the 4%, millionaire's tax, but of this $1.2 million, they're going to pay $215,000 in tax if they were not to 1031 exchange. If they 1031 exchange, they are rolling this whole lot into their next property. So they're going to be, and that's why we always say, you're going to build your wealth faster. You're going to preserve your profits. So you're going to preserve your $215,000, and you're going to put that $215,000 into a property. So now you're building your wealth faster because you are $215,000 up. Any questions about that as we move on? Okay, so what I do, we are qualified intermediaries. We are a neutral third party. One thing that we do is we handle all of the paperwork. So we make sure that all the exchange is structured properly, that it's documented properly. And the most important thing we do is we hold the proceeds. So the investor or your client cannot hold the proceeds from the sale. They do need to come to us. We hold those in a segregated sub-account. It's in the investor's name and their tax ID number, and then those are used specifically to purchase the replacement property. So what's that mean from a realtor standpoint? Really not a whole lot of change on your side. You're going to go out, you're going to list the property for your client, just as you normally would. You're going to find a buyer and take a contract, and you can take the deposit, same exact way. There doesn't necessarily need to be language in the purchase and sale agreement stating that you're doing a 1031 exchange. We have a lot of people that are calling me up and saying, I'm closing tomorrow. I just decided to exchange. They've never had any indication that they were going to exchange in any of the documents before that. That's perfectly fine. So language does not need to be in the purchase and sale. So you take the purchase and sale agreement and you take the contract and you take the deposit. From there, you're going to go to closing just as you normally would. We are going to reach out to the closing attorney and we are going to send them documentation on how to draft the settlement statement. Essentially, the settlement statement is going to have us listed as seller for the investor. It's also going to show proceeds to Northern 1031, which will have the amount, and proceeds to the seller, which will show 0. So same thing at the closing, you're going to do a direct deed from the seller directly to their buyer. The proceeds are going to come to us. This is the day the clock starts ticking. Your clients have 45 days to identify a replacement property, and I'll get into that. And then they have 180 days to close on a property. So as a realtor or as a financial advisor who's getting DSTs, you're going to do the same thing. You're going to get into a contract with a seller. You are going to directly deed the property from the seller to the taxpayer, and we are going to use the proceeds at the closing to purchase that property. That all has to happen within 180 days, which honestly is not the problem. So the 180 days is usually very easy to do. Especially for the DSTs, those are quick, and we'll talk about those in a little bit. It's really the 45 days. The 45 days is the hardest part. So you have to get your client a property to identify within the first 45 days. And let's talk about how they can identify. They can identify in only 3 ways. And really, we typically only use 2 of these rules. So if your client is selling one property and they're buying 1, maybe 2 properties, they can use the rule of 3. And the rule of 3 says you can identify 3 properties and it doesn't matter what the value of the properties are. They can buy one, they can buy two, they can buy all three of them. So that's the most common rule that we utilize. The other rule, if somebody is going to diversify, so they're selling one apartment building and they want to buy 5 condos for each of their children. Well, the rule of 3 won't work because they want to buy 5 properties. They're going to exceed 3 properties. So they can use the 200% rule. And that states that you can identify an unlimited number of properties, but the aggregate value of all the properties that have been identified cannot exceed 200% of what they've sold, which is limiting. So if somebody's selling $1 million property, they can identify $2 million worth of property under the 200% rule. So they can go out and identify 10 $200,000 properties or 5, I can't do that math, $400,000 properties. So it's limiting, but it works if you're diversifying. And that's when we're talking about doing DSTs, that is typically what people use is the 200% rule. The last rule is very rare, and it's in very specific cases. And it says that you can identify an unlimited number of properties and an unlimited value. But once you've identified those properties, you have to purchase 95% of them. So it's used when somebody is very sure that they're buying all of their property and they're buying up in value and buying lots of properties. So it's very, very specific, and we very rarely use it. Any questions about the identification rules? I should note that when we were talking about the identification periods, note that these are calendar days. So if your ID falls on a Sunday, we typically require that you have your ID into us the Friday before, as it's a business day. Same with the 180 days. If your 180th day falls on Christmas Day, note that you have to purchase before the 180th day. So that's really important to note. Those are not work days. Those are calendar days. Any questions about that before we move on? Good. And welcome everybody who I have not welcomed. So I know people have been kind of popping in as we've been talking. So if you've missed any of this webinar, it will be recorded and sent to you afterwards too. So just so you know, if you've missed the first few minutes, you'll get it all. So here are some exemptions for 1031 exchange. We get lots of people that call and say, oh, I'm going to just sell my primary residence. I want to do 1031 exchange. It's not for primary residences. You have your own, that's a 121 primary residence tax exemption. So there's an exemption for it. So as a realtor, if somebody's selling their primary home, this is not an option for them. Same with the second home. If you are selling a second home for them where it's a property down the Cape that they use exclusively for personal use, they do not rent it. They do not show it on their tax returns as an investment property. Second homes have no tax benefit. So this is not for second homes. So other things that you cannot exchange stock and trade properties, meaning those flippers. So if it's a developer that develops properties and sells them, that's not exchangeable. Exchange property is long-term capital gains. And same with the flippers. You just purchased a property, you put in a new kitchen, you slap some paint on it, it's back on the market 6 months later, if you've never rented it, those are not exchangeable property. So unfortunately, I wish they were, but they're not. We get a lot of calls from flippers, but it's just not exchangeable property. Stocks in bonds, those are not exchangeable. So we're talking specifically real estate. Interests in a partnership. So if there is a LLC that owns a property with multiple members, and one member wants to just cash out in and the other members want to go into an exchange, you can't just sell your portion or exchange your portion of that partnership. Remember when I said earlier, it has to be a continuity of taxpayer and title. So if the LLC owns the property, the LLC needs to take title to the property. You can't just carve off a portion of the LLC. LLC partnerships and corporate partnerships are it's like a divorce. So if people own properties with multiple members within an entity and they are talking to you about an investment property that they have and thinking about selling it, you need to have that conversation a long time before they actually sell it. Because there's time that we can maybe do a drop and swap where you can drop their names out of the LLC, pick up the title in a tenant in common ownership. And then if they're tenants in common, you can do a very easy exchange. So you want to have those conversations long before they're listing their property and getting a buyer and all of that. So, and we can talk more about that if you guys have questions on that. Like I mentioned earlier, primary residents have their own tax exemption, and that is married taxpayers filing jointly have $500,000 tax exemption. They can take advantage of this. They can take advantage of this every 2 years, as long as they've lived in the property for 2 of the last 5 years. And like I said earlier, second homes, vacation houses do not qualify. If you are single, it is a $250,000 tax exemption. You can combine a 1031 with a 121 a couple different ways. So if somebody owns a 2-family house and they live in one half and they rent out one half, they can take the primary residence exemption on the value of the first of their primary residence on their side of the property, and they can do a 1031 on the rental property. So that's one way to combine a 121 primary residence tax exemption with a 1031 investment property exchange. The other way they can do it is they can have lived in the property for the first 2 years, rent the property, move out of it, and then rent the property for 2 years. And now, because they've lived in it for 2 of the last 5 years, and they've rented it for the most recent of that time for 2 years, they can combine a 1031 with a 121. So they can take their $500,000 tax exemption and they can exchange the remaining portion. So this is really good if somebody has a single family house, they've lived in it, and they have $1 million in equity or $1 million in gain, and they don't want to pay it. So they can combine those two in that way. That's a brilliant tax move, especially if somebody has like a second home. I was just on the phone with somebody, and I don't know if they're on here today. I'm just trying to look, but that they have an investment property, a primary residence, and a second home. They're thinking about they want to eventually sell their primary residence, but they have a huge gain. So they're going to move into their second home, and they're going to rent out their primary residence, and then they're going to combine their 121 and 1031. So brilliant tax move. Let's see. Vacation homes. So again, I've mentioned it before, second homes do not qualify, but vacation rentals do. So all those VRBOs, all those Airbnbs, all those properties will qualify. The IRS wanted to make a distinction between what a second home is and what a vacation rental is. So they put together what's called a safe harbor. If you follow these rules, they will not question the exchange. They will allow it. So vacation rental, what the IRS will consider a dwelling unit held for investment purposes if these requirements are met. And the first one is that you have to own the property for 24 months prior to the sale. You have to have rented the property for at least 2 weeks for each year leading up to the sale to an unrelated party. If it's a related party, if you're renting it to your son or your daughter, it has to be their primary residence. It has to be kind of like a year-round primary residence rental. But if you're just renting it to, out on Airbnb, the minimum is 2 weeks a year, each year, at fair market value. But the thing is that you have to restrict your personal usage of that property to no more than 10% of the time that you've rented it. Or 2 weeks a year. So as long as you've rented it and you've restricted your usage, you can use that as a vacation rental. Any questions on that? On that vacation rental? I get a lot of calls on vacation rentals. Okay, we will move on. So as a realtor, as an attorney, as a financial advisor, really big one. These are the reasons that people are looking to exchange. People are saying, you know what, I'm young, I'm 20 years old, 25 years old, 30 years old. I want to build my portfolio. I want to start buying properties, leveraging them, taking out equity and building my empire. So leverage is a really big one when they're starting out. Diversifying, same thing. We've got those young investors that are selling one property and buying multiple just to build their portfolio. But as they get older, people are starting to consolidate. So the older investors will typically want to consolidate. They've got properties that they've acquired through their whole life. They're spread across the state or across different states, and they want to start consolidating and maybe buy one big building. So those are usually the people in their 50s and 60s that have a little portfolio and have some money to put in. Cash flow is always a big one. People may be starting out and they're kind of in like a lower rental income market, and now they have a little equity they can buy in a better market that drives bigger rents, and it will cash flow better. So cash flow is a really big one that people like, especially those younger investors that are building their portfolio and building their real estate. Management relief. Here's all of our 70 and 80-year-olds. We have our 70 or 80-year-olds that have had properties for 30, 40, 50 years. They are done with being a landlord. They're done with the tenants and the toilets and the trash. They don't want any part of it anymore. Their kids don't want any part of it anymore. They just need a management relief, and an exchange works for them. So the property that worked for them well for the last 30 years doesn't work for them in retirement anymore. Let's get them into a property that makes sense. And it may be a triple net lease property. It may be a Delaware statutory trust, which I'll talk about in a second. It may be a property that's just a condo that's brand new, that there's a homeowners association and a property management company. They don't have to worry about the lawn or the snow removal. It's just relieving their management burden. But getting those clients into properties that make more sense for them in their time of life. Increasing depreciation. There are clients that they've hit their 27 years of depreciation, and they need to take that. They need to buy another property that's a higher value that they can start taking that depreciation because they need that for their tax returns. Those are typically the savvier investors. And lastly, estate planning. 1031 exchange is a great estate planning tool. Those clients that you have that old 2-family in Cambridge that haven't done anything to it in 30 years, their kids don't want it. I know that sounds crazy because it's a $2 million property in Cambridge or Somerville, but their kids don't. Most of their kids want something that is more manageable. So it might be a good way to get into either a passive income stream like a DST. Again, I'll talk about that in a second, or get your kids into properties. So you have 4 kids, none of them talk to each other, which happens. And so you have one property, they don't want to deal with each other. So you buy a property for each of them, even though it's under your tax ID number. But you buy a property that works for each of your heirs. So when you go to do your estate plan, it's very clean and seamless. So that's estate planning we do a lot of. Any questions on that? We talked really quickly about stepped up basis, so I'm not going to get too deep into that, but things to note about stepped up basis. Your heirs will inherit a stepped up basis. So the value of the property upon the date of the investor's death is what the heirs will inherit. That is the goal. If somebody owned a property and they had a $50,000 basis and the property's worth $1 million, if they deed the property or gift the property to their children during their lifetime, the heirs now inherit the original $50,000 basis. So that's not a great estate planning for the heirs, certainly. There may be other reasons to do that. Medicaid, security kind of, no, I don't want to say hiding your money, but because that's not the right term, but protecting your money from Medicaid. So if there are people that they know they're going into a nursing home or they have to have Medicaid or they have to go into a nursing home or whatever, they may deed out their properties. They have that 5-year look back period. So that's a totally different animal. I'm speaking about just the people that are, I'm speaking just from an exchange standpoint. The best way to do it from an exchange standpoint is allow your heirs to inherit the property after your death. But everybody's different and there's reasons for doing it the other way. I'm just talking from an exchange standpoint. Okay, DSTs. I know I've mentioned these a few times, so I'm going to explain what I've mentioned. And this is, Jim, I know you're on the call. I think you're still on the call. So Jim, you're still on the call. This is something that we were discussing this morning. A DST, it stands for Delaware Statutory Trust. A Delaware Statutory Trust is considered an investment property, considered replacement property in the eyes of the IRS. It looks and feels similar to a REIT, but a REIT is not considered exchangeable property by the IRS. A DST is, and it is essentially a fractional interest share in a larger property. So you are becoming a tenant in common in a large property, something like an Amazon distribution center or a 250 unit apartment complex. So you can exchange from a single family house or a rental property that you own and go talk to your financial advisor who brokers these DSTs, and they can find you a property that works for you. What's great about them? They are truly passive income. They are mailbox money is what we call it. You put your money in and you get typically anywhere from a 4 to 5% dividend. It gets paid out monthly. It's an annual yield. So yeah, you complete your exchange, you defer your taxes, you put all of your equity back to work for you, and you're getting paid. 4.5 to 5% is not great, especially when the market made 16% last year. But remember, you did not pay capital gains tax on it. So there are financial advisors that will say, just sell your property and we'll put it in the market for you. Well, they're not accounting for the 30 to 35% that you have to pay in taxes before you reinvest. So you're down 30% if you're going into stocks. This is similar, but you're investing in real estate. So you are you are buying underlying property. You can pick the property that you want. Here's the downfall is that it's not liquid at all. So you put your money in and it sits until the sponsor decides to sell that property. So it's not great if you want liquidity. And it's not guaranteed. So they tell you it's 5%, and the sponsor usually has a fairly good idea of what they're going to pay out, but it's not guaranteed. So you could potentially lose principal as well. But the goal is they want you to continue to reinvest into their properties. So the sponsor is going to have you invest. They want to buy a property low. They want to hold on to it. They want to sell it high where they get a little equity more for their clients. And then they want you to reinvest into their next property. So if you're they're losing you money, they're not going to get you again. So they try to do a really good job in making those investments worthwhile. Any questions about DSTs? And we have a financial advisor on that might be able to answer some questions too if you have real deep questions about those. Okay, we are nice and quiet today. Again, feel free, turn on your camera, turn on your microphone, and ask any questions if you have. But we are getting to the very last slide, and I'm going to tell you what you're going to look for in a qualified intermediary. So just like attorneys, just like realtors, just like financial advisors, QIs are not all created equal. In the QI industry, I'll tell you, is a little bit of the Wild West. It's not a highly regulated industry. There's no real state licensing. There's no federal licensing. So unfortunately, anybody can kind of hang their shingle and open up their doors to be a QI. So it's important to know who you're working with and what precautions they have in place for your clients and the proceeds that they're holding. So these are the questions to ask. Certainly utilize the Federation of Exchange Accommodators. They are the only trade association that's nationwide that's for qualified intermediaries. So you can go on to 1031.org and make sure that your QI is a qualified intermediary and a member of the Federation of Exchange Accommodators. We sign a code of ethics. We go to annual training, and they have training throughout. So there's education, and there is what's called Certified Exchange Specialist, which again is a trade association certification because there's nothing federal or state. We are a bank-owned qualified intermediary. So that's really important too. We are audited by a third party. We are, the FDIC comes in and reviews our 1031 exchanges and our accounts. All of our funds are held under dual control. So we can't have an employee go rogue and take anybody's money. Northern Bank has been in business for over 65 years, and we've had the qualified intermediary business on Northern 1031 Exchange since 2015. We started our first exchange in 2016. So I have been here since 2014, so since the inception of 1031, and that's all I do. So we have a whole team that works with us. So we would love to earn your business, and I'm a great resource for any clients that you may have. So my whole job is to do these seminars, to talk to clients. I spend my entire day on the phone talking with clients, getting them comfortable with the process, answering their questions. We don't get paid until they close. So everything that I do, there's no fee for service when you're talking to me. If I'll talk to somebody 2 years ago and won't hear from them, and then they'll call me 2 years later and say, oh, I'm ready to exchange now. Our fee is typically $1,950. That covers the sale of their relinquished, the purchase of their replacement. Fees change if the complexity of the exchange changes, or if it's a reverse exchange or forward, there are other fees that are involved. But for a standard exchange, that's our fee. And it gets tacked on to the closing costs. What else can I answer for you? Any questions? I don't see, let's see if anybody's in the chat. Hi, Jim.
Hi, Michelle.
Hi there. Were you going to ask a question?
Yes, thank you so much. First of all, terrific presentation, very well delivered. And my question was, when would the recording be available after this? I know you mentioned that it would be sent to us. I was just curious as to when we might receive the recording.
It's usually this afternoon.
Terrific. Thank you. I know we'll be talking thereafter, but I just wanted to say thank you for this invitation. Very well done.
You're very welcome. Thank you. Thank you for joining.
My pleasure.
You want me to mention the 121 again, Susan? So the 121 tax is the primary residence tax exemption. Is that what you're talking about? You get a $500,000 tax exemption for a primary residence if you are married filing jointly, and 250 for a single. Did you have any other specific questions about that? You can take advantage of it once every 2 years. Okay. Any other questions? We have, I typically allot about 45 minutes to an hour. We're just approaching 45 minutes. What if you're selling a vacation home property, like a condo, where they limit the number of weeks that the unit can be rented? Yeah, unfortunately, that's going to be a deal breaker. So if they limit it and it's remember, the minimum is only 2 weeks. So if the minimum, if they say no rentals, then that won't work for an exchange. I have an association that says no rentals. I can never exchange my second home. I can never change it into an Airbnb. But if it's limited, the minimum is only 2 weeks a year. So you should be able to exchange that. They just have to remember to restrict their personal usage. Did that answer that, Leslie? Okay, good. Any other questions? You can put them in the chat. You can unmute. I have another question. Oh, thanks, Natasha. Yeah, so John and I, Natasha was saying that she works with John Starling. John Starling and I work together. So he didn't hop on today, but yes, I'm glad to be doing business with you again and your client. Thank you, Natasha. Anybody else? We've got a couple minutes left. Well, if there's nothing else, I want to thank you so much for your time today. I hope this 45 minutes was well worth your time and you learned something from it. Like I said, the recording will be coming out this afternoon, so please be on the lookout for it. If you have any questions, I have my information up and you can feel free to email me. My email obviously comes into my phone. My office line rings right into my cell. So feel free to give me a call with any questions. And thank you so much for your time. I'll hang on for just a minute.